I hope everybody enjoyed their Christmas and you got to spend some time with your family and your loved ones. Nick here from Ways of Wealth. Thank you for tuning in. It is week 52 of the market recap. It is the finale. Thank you to everybody who has followed along the way. I appreciate your support and I'm looking forward to seeing what we can do, what value I can bring moving into the new year. Looking back at what a crazy year 2020 is, I just hope that we can look back and say, I learned this about this year. And if this for you was you cannot handle stock market volatility, then I have a perfect video for you coming up. In this video, we are going to talk about a portfolio allocation that will help limit as much downside as possible. But quickly before we get into the video, I'd like to ask you a huge favor. If you learn something new or you get some value out of the video, hit the thumbs up button. It lets me know that you appreciate what I'm doing. And my Christmas gift this year will cost you absolutely nothing. This is hitting the subscribe button. It is absolutely free to you and would mean a lot to me. And don't forget, if you're enjoying the content and you want to know when I post a new video, hit the notification bell on. We do this every single Sunday. Off the stock market high on February 19th, 2020, we saw the quickest plunge in stock market history that we have ever seen before. The stock market lost 30% of its value in only 22 trading days. This means in only 22 days, if you had 100K invested in stocks, 30% would be absolutely gone. The last time we saw a drawdown this quick was the Great Depression. Yes, that's right, the Great Depression. Looking back at earlier this year in March, I was overwhelmed myself with emotion. I was wondering, is this going to be the Great Depression 2.0? Although unemployment rates did reach that 15% mark, they weren't as bad as what they were in the 30s, where they reached up to 25% of the labor force being unemployed. And of course, hindsight is 2020, but when you're caught up in those emotions in March, you think, do I panic? Do I sell all my stocks? And if that's something that you did and you're looking to avoid doing in the future, then I have the perfect portfolio that will help you sleep at night and not have to worry about the wealth that you've built over your lifetime. And in order to find this sleep at night portfolio, welcome to portfoliocharts.com. If you're not familiar with this resource, it's an absolutely wonderful tool. You can go in here, you can customize your own portfolio, and it'll backtest it all the way back to the 70s to see how it performs year over year. And it also has pre-recorded popular portfolios, the All Seasons, which is similar to the All Weather portfolio by Ray Dalio. And you can go and click in here and see what each asset allocation is and see how they performed over the past couple years. Before I went through every single portfolio, I happened to find a blog post by the creator. The gentleman's name is Tyler. He's done an absolutely phenomenal job with this website. You go into the insight section and he has an article titled "The Top 4 Portfolios to Recession-Proof Your Investments." And we can see here that he has back-tested every single portfolio during some major downturns in the market. The first one, for example, is 1974. And we see these 4 portfolios that have kind of limited the damage that the total stock market did. It almost hit negative 35%. But you had the permanent portfolio, which actually had a positive return during that year. It even goes back to 2008, and you see the 4 names consistently showing up here. 1970 was also a really bad year, and we have the Larry, the All Seasons, the permanent portfolio, and the Golden Butterfly all standing tall, being some of the best portfolios to have to protect your investment during a economic downturn. And we can see the four here of what they are comprised of, but the one that I enjoy the most after looking at all of them is the golden butterfly, and we'll take a look at why. So we'll click on this golden butterfly to go into the individual portfolio, and we can see the asset allocation is highlighted again here. It's 20% total stock market, 20% small cap value, 20% long-term bonds, 20% short-term bonds, and then 20% gold. And from there, you can actually come down and see how it is comprised. So if you want to go in yourself and customize it, it'll provide you with that opportunity. But we're not going to touch anything because we want to see this golden butterfly in particular. You can come in and change the country, the home country here. If you happen to be in Canada, it might provide different results. But for leaving things the same, let's take a look at the USA and what the data is comprised of here. So it automatically puts in all this information of 20% total stock market, 20%, small cap value. So we're not going to touch anything here. We're just going to move down. And we're going to see the annual returns and the standard deviation of such. So it on average provides 6.4%, and the standard deviation is 7.9, so that can be plus or minus. We're not going to touch too much on that. We're going to see what the equalizer looks like, and this is what the average return is going back to the 70s. And what we can notice is that there's not too many times that it dips below into the negative territory, and the balance is +4, which is very good. From there, we can see what $10,000 invested looks like over a 10-year time frame. And their deviation is because we don't know where that original investment is being made. Is it on a day that the market is flying high and then there's a pullback? Or is it on a day that's on a downtrend and then you happen to have a better portfolio return over the long run? So from there, that's where the standard deviation takes into account. Investing $10,000 in 2008 during the crash is a lot better than what it would be in 2007 at all-time highs. So from here, over a 10-year span, the minimum return of that $10,000 would be just shy of 15K, all the way up to 22,150. So all positive, no numbers after 10 years are less than that 10,000 of original investment. So that is very good. Moving down, you can actually come and see what that $100,000, this is customizable. You can come in here and put your specific numbers. So let's say you wanted to start out with 10,000, you can come in here and edit that number yourself. You can also add the annual contribution of what amount you would like to add to continue, and it'll show you what your investment would look like over a 30-year span and what kind of numbers you could achieve. So the goal obviously is $1 million, and that's highlighted by this line here. Based on when you started investing, it could take you 21 years, or it could take you 27. So at least it gives you an indication of how this portfolio is going to perform over the long run. But getting into what I find the best is the drawdown. So if you can see here, it only draws down deepest 11%. Now, the way that this is important is because we saw with the total stock market in 1974 get down to almost 35%. We saw earlier this year in March, the market drop off over 30%. The deepest that this portfolio has gone is 11%, and it only takes the longest 3 years to recover that money. So you can take a look at other portfolios, but this one will be one of the best in terms of protecting that capital on the downside. And the Ulcer index here is 2.7. Now, what the Ulcer index is a technical indicator that measures downside risk in terms of both depth and duration of price declines. Basically, what you want this number to be low. It means that there's measures in place in the portfolio that are going up while stocks are going down, and that's what's basically helping it out in a nutshell. Now, to show you an example of this, what we'll do is we'll show a comparison of the permanent portfolio, which was the one that had positive returns during that downturn, and we can see that the Ulcer index is just marginally better at 2.4, but the drawdown happens to be greater than what the golden butterfly is. 14% was the deepest drawdown that it had, and it took almost 5 years to recover. So you can come into this site and you could take a look at this for yourself, but we'll go back to the golden butterfly and we'll look at some of the other information that it has. The heat map here, for example, gives you what the compound annual growth rate is based on the years held. So obviously going back to that important 1970 day. But you can also see if you started investing in 2015 of what that looks like, all the way up to 2019. Obviously this year is not complete yet, so we don't have all of the data. It also shows you your rolling returns and what that looks like going back to 1970 in 10-year intervals there. It also shows you the long-term returns, and you can change anything in this black. It's fully adjustable, customizable based on what you want. But the important part here is what the compound annual growth rate is, and this should be real, which means that it is adjusted for inflation, so that inflation number is taken out of it. And what you can see here is that this golden butterfly portfolio protects you on the downside, but should also return you 6.3% after inflation every single year. And if you think about it, the S&P 500 does 7 to 9% year over year. So you're only sacrificing only just a little bit, but you're getting that massive protection on the downside. Just to give us an example of what the difference is, we'll go back to the permanent portfolio and we'll take a look at what that is. So over that 10-year period on the permanent portfolio, your compound annual growth rate is 4.6%. So almost a 2% difference between that and the golden butterfly. And this is the reason that the golden butterfly is the portfolio for me. If you're looking to limit the downside but still want to take part in that market growth, so this is the one that, you know, I would definitely suggest as a safe portfolio for you to have your invested money in. It also shows you retirement spending if you want to go into much more detail, but I will leave that up to you. But I would definitely suggest going and checking out and seeing the other portfolios here, but definitely know that the golden butterfly is my portfolio choice. I hope you enjoyed this relatively new style of video where I actually take you into the websites that I'm researching. The golden butterfly is a great choice, but if you're looking for something with a little bit more growth, I would definitely suggest you going into the website and seeing if there's a portfolio that better suits you. But that's all for this week in the market recap. I appreciate you watching, and again, if you made it this far, if you learned something new, hit that like button. It definitely helps my channel out. And if you haven't already and you're enjoying the content, hit that subscribe button, turn this notification bell on. We do this every single Sunday. I hope you all have a great week on the markets. Looking forward to speaking to you all in the new year. Happy trading.